All right, welcome back to Nadlan Forum Podcast Daily. I'm Ruby and I'm here with Lior. So the big headline today is the OECD just boosted their global economic growth forecast for 2025. Lior, I know you're the one who devours these reports top to bottom. What's changed since June?
Yeah, so really interesting numbers. The OECD now thinks global growth will hit 3.2% this year, which, if you remember, back in June they had it at 2.9%. Not a minor adjustment, right? It's actually a pretty positive surprise, mostly because of the strength in some very specific emerging markets. And I'm not sure anyone expected Brazil, Indonesia, and India to play such a big part this year, but they're driving a chunk of this resilience.
Those three have seriously been on a tear, right? I think people always expect China to lead the pack, but this year's been totally different. What's going on with them?
Yeah, so a lot of it came down to these countries ramping up their industrial production and trade right before the new tariffs hit. Basically, they front-loaded a lot of business, like moved faster to ship goods and invest before things got more expensive. It's a classic move, but honestly, didn't always work this well in past cycles.
Right? Like rush to beat the deadline makes me think of those mad end of financial year sales, but on a, slightly more global scale. Did the US see any of this upside, or is it all emerging markets?
Actually, the US got a bit of a lift as well. The OECD upgraded 2025 growth to 1.8%. Not huge compared to 2024's 2.8%, but still better than folks expected. Some of that's down to AI-driven investment here, which, by the way, is something we touched on a couple of episodes ago when we talked about technology in real estate.
Yep, the AI angle keeps showing up everywhere. So, you mentioned once how you kind of lucked into a hot market back in Tel Aviv before it was cool. Tell us that story again, because it actually fits perfectly with these markets surprising everyone now.
Yeah, so back in the early 2000s, I was working on a startup in Tel Aviv. Totally not sexy at the time, and people were betting on all the wrong neighborhoods. There was this area north of the city. No one wanted to touch it. I kept saying, this place has the bones, it's got the potential. Anyway, long story short, that little area took off 3 years later, almost overnight. It's kind of like what we're seeing now. Brazil or Indonesia weren't top of the list, but suddenly, if you had your bets there, you're looking pretty smart.
Classic. That is the ultimate nobody saw it coming move. Okay, so these emerging markets are shaking things up, but I feel like every time we get good news like this, there's always another shoe about to drop.
Yeah, positive news on growth, but the bigger issue in the background, and honestly, everyone's kind of holding their breath, is these US tariffs. Tariffs are now at the highest rates since 1933. That's wild. Like almost 100 years. And we're seeing it hit all kinds of imported goods, with some countries facing up to 50% tariff rates on their exports to the US.
I always get deja vu with tariffs. Every time there's a trade fight, we say it's unprecedented, and then the numbers actually break records. But you mentioned earlier that a lot of the growth we just talked about is because people rushed ahead of these tariff hikes, right? Can that really last?
Yeah, that's the thing. Front-loading gave a temporary boost. But now that the rush is over, there's a real risk that things cool down. The OECD is basically warning, don't expect this pace to last through the end of the year. They actually see a general slowdown coming for the G20 as that effect wears off. So it's not a forever boost, it's a blip.
And these tariffs aren't just some background policy. This is showing up in the cost of stuff people buy every day. I wonder, maybe this is a bit of a curveball, but do you think higher consumer prices in the US will change how international buyers look at real estate here? And mortgages, especially with mortgage costs already under pressure?
That's a good question because, in past episodes, we talked about how international buyers are super sensitive to US pricing and exchange rates. If tariffs push up prices on goods, it can hit consumer spending and maybe even slow down housing demand, especially for those buyers who factor in total cost, mortgage payments plus living expenses. So yeah, I think it could make them hesitate or look for better bargains elsewhere.
Yeah, because it all feeds back. You bump up consumer prices, people get nervous, and boom, they pause on big investments. That's true globally, but feels extra sharp in real estate. Wonder if we'll start seeing those trends shift in the next set of numbers. All right, speaking of shifting, should we talk about the inflation wildcard?
Sure. So inflation was another piece where the OECD actually showed a little optimism this time. For G20, 2025 inflation is now forecast at 3.4%. That's actually down a bit from their earlier guess. And for the US, they made a big downward revision. 2.7% instead of 3.2%. So maybe not running away, but it's not nothing. Still higher than a couple of years ago.
Right, and even with the better forecast, you've got everyone, from businesses to regular folks, already reacting, like we're hearing about companies eating margin on higher costs and people feeling it in their wallets. But the OECD doesn't sound like they're, about to throw a party over this.
No, not exactly. They flag a lot of risks. Could be more tariffs or another pop in inflation. And the global financial system? Still on edge, especially with the way crypto and AI investments are playing into risk. The report actually says that crypto's wild price swings could mess with financial stability, which honestly, not a surprise if you follow that market. And by the way, some of this reminds me of the early days in New York's prop tech scene, where the line between optimism and volatility got thin really quick.
Oh, I totally remember you mentioning that. Prop tech startups promising to change the world, and then, well, not all of them stuck the landing, but the ones that did really changed how investors think about hedging against inflation. What's your take? Does AI still feel like a stabilizer or just more fuel for the fire?
Good question. AI investment boosted the US this year, sure. It's part of why the numbers surprised on the upside. But it can cut both ways. Investors looking for inflation hedges are putting a lot of chips on AI, hoping the productivity gains pay off. And that's why you see some crazy valuations. I think for property investors, the message is use tech as a tool, but don't count on it as a cushion against every risk. Stay flexible. That was literally the big takeaway in the report too. The whole global outlook is just complex. Not all danger, not all opportunity, just a messy mix in between.
That is pretty much the headline for 2025, right? Nothing is simple, it's all moving parts. So, for our listeners, whether you're worried about the next inflation report or you're hunting for the next surprise market, make sure you follow these changes closely. We'll keep breaking it down for you every week. Lior, this was a big one. Thanks for all the insights, as always.
Thank you. And yeah, if you listeners have questions or want a deeper dive on any of this, message us or check out Nadlan Capital Group for more. Ruby, always a pleasure.
All right, we'll catch you all next episode. Don't forget to subscribe, leave a review, all that jazz. See you next time, Lior.
Bye, Ruby. Bye, everyone. Have a great week.